Welcome, I'm Lindy Fuller, and this is the Summit Financial Wellness Series. Today we're talking about understanding your credit score. So I hope that's the topic you were expecting. We want to make sure everyone understands all the aspects about credit score. To start as an overview, we're covering credit report basics, your credit score, what hurts, what heals, the two different types of inquiries, as well as some valuable tips and next steps. Now, first, it's important we understand that credit reports are just a culmination of information gathered on an individual from creditors and public records. So they provide prospective lenders and other agencies just enough information to determine someone's identity and if they're creditworthy. So credit reports are not used strictly for credit anymore. We at the credit union use them for identity purposes all the time. So other places do too. That's why it's important to be sure that the information is reporting correctly. Now, checking your report for accuracy is super important. We want people to be able to feel confident when they're pulling their report, or maybe a lender is pulling it, that nobody else's information is filtering in. So it's a good idea to not just check your own, but also help your family check their credit reports. You might have kids or aging parents that you help take care of. Your children should not have a credit report at their age, but because of identity theft, fraud is a big deal. And if you see something there, then you certainly want to dispute it and lock it down or freeze it until they're ready. And that way it won't ruin their credit before they can even get started. And elder abuse is big in the financial world. So certainly look after them and make sure that the seemingly well-meaning uncle so-and-so is not actually getting a hold of important information and taking advantage of their credit and making more bills for them than they'll ever be able to pay. Now, I say check it regularly. How often do you think you should check it? Any guesses?
Once a month.
Well, that's a great guess. Some people do check it that often. You can check your credit a few different ways. If you use an app like Credit Karma, you can check it monthly or even weekly, just as far as the score is concerned. And that's going to be on just 2 of the 3 reporting agencies. But you can also check it yourself in the content of your credit, not just the score. Everyone can request a free copy of the report at each of these 3 reporting credit bureaus once a year. Now that's typical. Since COVID has happened, you have been able to check it much more frequently. And right now, if you were to contact them, you could probably check it once a quarter for free. But that is a constantly changing thing. The norm is once a year at each agency. So what I do is I put it on my calendar to check every 4 months a different agency, and it's recurring. That way, I'm constantly making sure it's accurate. That's important because you can't do everything you want to do financially if you've got someone else's information pulling in, or maybe the information that's reporting on you is not accurate as to payment history or collection or any number of things. Maybe even a middle name is wrong. We've had birthdays, any number of things that are inaccurate. You need to dispute that. It's worth your time and effort to make sure it's right. So you might monitor it more frequently than your neighbor, but that's okay. At least once a quarter is a good idea, but no less than once a year, okay, at each of those agencies, whether it's all at one time at each agency or scattered throughout the year. Let's take a poll at this point. Let's see what you all do. If you're willing to participate, I'm going to launch a poll. And it's just questioning, how often do you check it? You can be honest, this is anonymous. Okay, we've got 77%. We need a couple of more people to put in their answer. If they want, I'll give it 2, 1. Okay, oh, everyone did. Excellent. So I'm going to share these results with you. So 44% monitor every week or month on an app. I'm one of those people too. 44% also do it just once a year. That's perfectly fine. One of you every few years. It might seem okay to do that. You might never have any problem doing that. I just encourage you to check it more often for your own credit safety, because the accuracy can make such a big difference. There's sometimes things when we look, where did that come from? And we can fix it before we apply for a big purchase. And that'll be good, especially if it would prevent us from getting it otherwise. Now let's talk about the score itself. What is that score? Well, it's kind of a technical term here, but basically, your credit score is a number that represents your credit worthiness. So the closer that score is to 850, which is the highest credit score, the better. Now the national average is somewhere around 650. Again, it's a constantly changing number. It kind of ebbs and flows a little bit based on, how often things are reported to the bureaus, as well as how often the lenders report to them. So it's very, very important that we not get too hung up on the score moving a little bit. We want to pay attention though to drastic drops in our credit and maybe even jumps as to why, what happened. If you didn't do something to make that happen, it's important that you know and you look at it so you can figure it out. Ultimately though, this is why we all want a high credit score. It is because we want insurance and utility companies to give us the best possible premiums. When you call, they're going to ask to pull your credit. Well, they do that because they want to see what premiums they can offer you. Not just on your driving record, but also your credit. You also may know that employers often will look at credit. And good credit can give you an edge in getting that coveted position that you want, potentially even helping you get that job if others don't have good credit. You want the best rates and terms too from a lender. So if you're ready to get a personal loan, an auto loan, a home loan, whatever, you know that the higher your score is, the better the chances are that you get it, but then also get a good rate. What I like to say is that it's not what's in your wallet, like the commercial says, but it's how your credit score affects your wallet. So now we're going to look at some examples. This is a sample of an auto loan rate for a $25,000 vehicle or loan for 60 months. Can you see the difference on that vehicle's monthly payment and interest paid over the life of the loan? Our credit builder auto loans are half the rate offered to members that might otherwise be denied or resort to using predatory lenders. You might have heard everybody drives. Well, there's a reason everybody drives. It's because they're going to give that loan to anybody, no matter what their credit, but they're also going to give you an insanely high interest rate and probably keep you in such a bad credit cycle that you will never feel like you can recover. So predatory lending is not something I suggest getting into, because that becomes a cycle. Would you say then that your credit score matters? Definitely it does. Check out the difference in that monthly payment and then over that 5-year loan. I would much rather have that $7,000 in my pocket, right, than having had to pay all that additional interest. It's even more true for mortgage loans. because this is a larger purchase. It's more expensive and the term is much longer. So the better your credit score and overall credit worthiness, the better your monthly payment will be. This sample illustrates how you'll pay more than double in loan interest for the same property, comparing the A+ credit just to the C credit. And it's rare that a mortgage is even offered when scores drop below 600. Notice I said scores, more than one. That's because mortgage loans require a tri-merge, all three credit reports being pulled. And what they do is they use the middle credit score to score a loan. That's why we need to have accurate, high credit scores. Loans, especially mortgage loans, can be difficult to get if there's poor payment history or something like that. But if your score is lower than it should be because of other inaccuracies, wouldn't you be mad when it's come time to do that application? Somebody else's information's pulling in. So please, please, please check more than the score, check the information for accuracy, and be sure that you're getting the best possible score you can. Now, there's a lot of information on your credit report, and some of it does not factor into your credit score. So these bulleted items shown here are not used in the Bureau's algorithms for determining your score. The first bullet item does not even appear on a report. Even though some applications may ask for it, the other bulleted items are only helpful for identifying someone and lender verification. I'm a big proponent for you realizing you don't have to give every single box on that application an answer. You know, some of them have the little star. Those are the ones you have to do. Only do what you have to do because that's your information. Guard your information. It's important. And the more information that's just out there, the more likely it is to get out. Even reputable institutions have cyber incidents and things of that nature. So the fewer people that have it, the better. Now, loan delinquency really hurts, and this helps illustrate how it does. Lenders consider you delinquent the minute your payment is past due. But you could be late by a few days or weeks and even have a late fee, but your credit bureau doesn't look at delinquency the same. It looks at whether you're 30 days past due or not. So this is where you can learn to be strategic. If you have to be late, don't be more than 30 or don't be more than 29. Be 29 days or less late. Ideally, just enough to avoid even having a late fee. If it falls within that grace period, you don't have a late fee and you don't have a report to your credit. And that's great. Life happens. We're going to be late on occasion. But if we're that late, it hurts our credit so much. Look at how long it takes to get back those points once you bring it current. 2/3 are given back, but it can take up to 2 years to recoup them all. Also, I want to point out that if you have more than one loan that's currently past due, meaning 30 days or more past due, this can accumulate quickly, but you cannot have more than 150 points taken for any specific loan type. Okay, so if it is car loans and you have more than one and they're both late, it won't take more than 150 for car loans. Same is true for other types of loans. They're called installment, revolving, mortgage, all different kinds. So it's important that you know that if you need to be strategic. Now, collections are something that vary based on how many points are lost, because there's two different kinds. There's medical collections, and the other kind. The other kind are going to weigh a little heavier, okay? Those are typically utility bills or perhaps something that happens frequently. Maybe it's AT&T or Spectrum. Stuff didn't get turned in, equipment didn't get turned in, or they don't have a record of it. Maybe your deposit wasn't enough when you left that apartment and they had to clean it. Who knows what, but we've seen it all. And if it's not medical, then it's the other kind. When that hits your credit, it can take as much as 60 points. If it's medical, we don't know for sure because they just give us the range, but what we've been able to discern is that that's more like 30 points for medical. And then over that 12 to 24 months, it gradually comes off. But the heavier or more weighty portion is only in that first 6 months. So if you decide to pay something, pay it off right away if you can, or negotiate right away. That's when the points are hurting your credit the most. There is a saying that says time heals all wounds. Well, that rings true for credit scores too. As the delinquency is brought current and times go by, your credit score goes up. After 48 months, credit scores can be completely restored. Even though there's negative payment history visible, if that's over 48 months ago, it's not affecting your score anymore. And folks, that is true for bankruptcy as well. You will see those on your credit longer, but they are not affecting your score after 48 months. So here's some score tidbits for you. Expect bankruptcy information to remain visible on the report for 10 years and any other negative factors to be visible for 7. Don't let someone convince you that co-signing for them on their loan won't affect your credit. If it's on the report and you see it's on the report because you're checking, it can affect your credit for good or for bad, just as much as theirs. Finally, about 10% of your score is in the mix. That means having an auto loan, a gas card, a Visa, a mortgage, a mix of different types of loans is good for your score because you're tapping into an additional 10%. So let's talk about inquiries. There are 2 types of inquiries. Soft inquiries don't affect your score at all. Some good examples of that are maybe lender pre-approvals if you get those in the mail, or when you pull your own credit, or maybe you open up an account at Summit Credit Union. You just want a savings and a checking account. You're not applying for a loan. Those are going to be soft pull credit inquiries. Hard inquiries, though, they do affect your score, but after 12 months, you don't have to worry about those because typically it's 5 points. Can you see there? 5 points. And those 5 points, I like to say on the anniversary date of that initial inquiry, they come off. Okay. Those points no longer are being held, but actually go back to your score. Even though you can see the inquiries on your credit report for 2 years, just remember only 1 year's worth is affecting your score. Now, a few other things can hurt your score. So it's important you understand what they are. And this, for me, is huge. When a line of credit is maxed out or removed, a portion of your capacity to borrow is affected. Therefore, your score will drop drastically. And so many people do not realize that when they pay off a line of credit and close it, they basically shoot themselves in their credit foot, okay? You worked hard to get that line of credit. You have to keep it going. So pay it off and then just use it once every 6 months or so to keep it active, and then pay it off that same month so you don't have any actual interest to pay. This is another strategic way you can keep your credit score higher, and it also keeps that trade line active on your report. The longer you keep active credit, the more it helps your score long term. Unless you just can't handle having credit, please, please, please don't close your lines of credit. So you don't need to spend it all, just leave it there available, and roughly 30% of your credit score will be intact because you've got that capacity to borrow. Now, you could have one line of credit or you could have 10. It's only looking at the overall number. As long as you don't go over your limit. You go over your limit, you'll have some little points pulled for that, but you definitely want to keep your overall line of credit limits at 30% or less to be good, 10% or less to be ideal. And one thing I think surprises people is that it matters who you do your lending with. So if you choose a lender that's typically in a third tier level when it comes to credit, you're probably not helping yourself as much as you're paying that loan. The big hint is if the word finance is in their name, they're probably a third tier lender. Now, I say probably, not all of them, but many of them. So when you have an auto loan and it's a finance company, those typically are, and you're probably going to have a higher interest rate than you deserve just because you chose poorly. All I can tell you is now that you know, make the decision to check out your options. Everyone here qualifies just because they work at Guilford County. They qualify to be a member at the credit union here. So we want you to be able to tap into the best possible opportunities for lending and get the best possible rate. And we're offering the education too. So please use us, take advantage of us. If we can help, we want to. So to improve your credit score dramatically, I want to challenge each of you to do this for 1 year. Focus on bringing your loans current if they're not already. If they are, great, but keeping them current, paying on time, but definitely less than 30 days past due if you have to be late. Also, paying down balances without closing lines of credit. And some people have no problem with this. They almost never ask for new credit. But if you are in the habit of applying for new credit frequently, that's another red flag. Every time you apply, you have a hard inquiry, and roughly 5 points comes off of your score. Now, there are exceptions to that. If you're specifically going car shopping, and because of that particular lender, let's say you're having your credit pulled rather at Ford Motor Credit and Chevrolet and Lexus or whatever, you've got obviously, places are car dealerships. You're only going to have that count as 5 if it's within a short period of time, typically 30 days or so. It works very similarly too with a mortgage. So if you're mortgage shopping, that could also be the case. My recommendation is get pre-approved at the credit union or wherever you trust to get pre-approved, then go shopping. That way, you've only got one person looking at that really private information or one company. And again, the fewer people looking at my information, the better. So don't apply for new credit unless you just absolutely need to. Now, Kay had a question. If you do close a credit card, how long does that action negatively affect your credit score? Well, Kay, I can tell you that that's almost an immediate effect, and it's just because you take away that capacity. So if you've got that one card and it's got $1,000 limit and 30% of your score is tied up in it, what you're looking at is having that whole 30% gone instantly. Now, if you had half of that on the balance before you did it, you paid it off and closed it all at the same time, then you're only looking at about half of that 15 or so, because it was already using the other 15%, or 15%. So you're going to see it be drastic, but it's just that one time right away until you get another line of credit. It's going to just not be a portion of your score. It's kind of like the 10% that's available to you in the mix. Until you start getting different kinds of credit, you just don't have that 10% in the mix portion available right away. And if you start closing stuff and you end up with only one or maybe two types of credit, then the same thing is true. Then you just no longer have that 10% access. Excellent question.
I have a question.
Okay.
So I'll just use myself as an example. Back in the day when my credit wasn't really where I wanted it to be, I got a credit card and it has an annual fee that they bill monthly. So instead of canceling it, I've been leaving it open because this year I do plan on applying for a mortgage. But that monthly payment that I make for the annual fee, does that constitute as leaving it active, as you said? You said to use it once every 6 months. So aside from making that payment, I still need to go in and maybe purchase something and pay it right back off?
That's a good question for them. My guess would be yes, is because it's activity. You actually have to make that payment. So to me, that would be activity. But when you're not sure, ask them. They know their terms best. I am very cautioned with companies that have an annual fee and want you to pay it monthly. How big is that annual fee?
It's like $8 a month.
Okay. If it's worth it to you to keep that open because that might be your oldest trade, the only time I would consider closing that, Rashawn, is replacing it. So if you close it because you've got another one for that amount or higher. But whatever you do, it's your decision. And I would not, since you're in the process and you're so close to doing a mortgage, I would not do that before you get your pre-approval and everything done, closed on your mortgage. Then maybe think about doing something else. I wouldn't encourage any changes to your credit before that process is complete.
Okay, thank you.
You're welcome. Let's see, Ms. Graves, how long can a delinquent car loan affect your credit? Well, if it's currently delinquent, it will remain affecting your credit until it's paid or brought current, until it's charged off. If it's charged off, it kind of goes into another category all by itself. But negative credit, even after the time frame that it doesn't affect your score, which typically is no more than 4 years. If it gets to the point of a charge off, though, then it sort of gets into a different category all its own.
Got it.
You have another chunk of points that come off for it getting to that point, and it just becomes a little stickier.
Mhm.
But if you never pay it at all, it's 7 years from the last activity, assuming that the creditor does not reactivate that debt.
How long can a creditor continue to activate it if they could?
Well, laws change all the time, and there used to not even be laws on it. But my understanding is that there's certain restrictions with certain types of companies. I don't know for sure if that a car loan would be included, but I do know that with unsecured debt, there are rules about that, and they have options whether to, turn it into a charge off, a collection, or both. But I don't think that they're allowed to re-up it, if you will, anymore. But the laws change, so I don't really know the time frame and if that has changed since I checked last.
Got it. Thank you.
You're welcome. The best thing you can do, especially if you've got another car loan or even a mortgage in your sights, like within the next couple of years, is to negotiate, to bring things current as fast as you can, maybe even settlements. There's nothing wrong with that if the lender agrees to it. If they agree to it, then it's the same.
Okay.
But you want to get everything in writing. And the reason you want to get it in writing is because if they don't do their due diligence on their side and reporting it to the credit bureau, you can dispute it and show proof. And if you're making payments according to that, you should be able to show proof that you're making those payments and when that should be done. Again, it's harder with non-reputable lenders, in those scenarios. So always be strategic with who you lend with, because if they have nothing to hide, they'll be transparent with you. I hope that makes sense. So much of your score, roughly 35%, is held in how well you pay your credit. Okay, so simply paying your bills when it comes to your credit is huge. Every 12 months that goes by where there's no late payment, that is, according to the Bureau, 30 days late or greater, then you're going to get bonus points. You're going to get points added to your score for good payment history, up to 35% of your score for that. So it's no small thing. And definitely keep the lines of credit open for as long as you need your credit to be active. Now, I know some of you did not get the first portion of our workshop today, but I want to recap this. And then if you have questions, we can always go back and revisit some of the other slides. Super important. Monitor your credit using annualcreditreport.com. Annualcreditreport.com is free. It's not advertised for free, but really has a fee like some places. It's truly free, but you're pulling it yourself. So it's a soft pull. What you want to do, make on-time payments. And if you have to be late by less than 30 days. Ideally, pay your credit cards down to 30% of the limit or less if possible. That will allow you to have more capacity to borrow. And from a lender's and a creditor's point of view, you're not a risk, not nearly as much of a risk, because you're able to handle having available credit without using it all. Does that make sense? You have to have credit to get credit, and then you have to use it right to keep it. The other thing is, don't apply for credit too often. My recommendation is maybe have your credit pulled 2 times a year on the average. So some years you might not need to pull it but once, and other years maybe 3 times. But certainly you don't want to get in the habit of having it pulled just because you're at the JCPenney counter and they're asking for 10% off of today's purchase. As great as that is, my answer is always no. I guard my credit like a junkyard dog, and that is because I know that I've got the credit available to put if I need to put that on credit, but I don't need 5 points taken off for a credit inquiry, and I don't need 10 points taken off for a new trade line for the next year. It would be holding 15 points hostage on my credit for something I don't really need. So when you know that, you've got information to arm yourself with, and you don't have it pulled unnecessarily. Okay, the last bit is having a good credit mix, keeping a little bit of different types of loans in there. If you've not been able to build any credit yet, we have a credit builder program here at the credit union that allows for several different types, and even some that really are more of a secured loan type of thing, where you have a secured credit card. You're securing it with your own money. Yes, annualcreditreport.com. This is my favorite part of this, because we're allowing anyone who has not experienced a credit score analysis before, whether you're a member with us or not, you're certainly able to get access to what we have here. Now, credit score analysis essentially allows us to offer our business partners, again, even if they're not members, their employees like yourself, the chance to sit with one of us. We're trained professionals. We know what the credit report is saying when it says what it says. We know where your score is at. We understand what's up with it. We want you to understand it too. And this is not something you're born with. You know, understanding credit is learned. So I would suggest that you reach out to either myself or one of our representatives in the branch so that we can get you set up with a credit score analysis. You need to know where you're at if you want to know where you're going to be, right? And we've had tremendous success with Guilford County. I've probably had 1 or 2 credit score analysis every week this month, just with Guilford County folks, because of the series that we've been doing this month with credit score. People see the value in it, and I definitely think you would enjoy it. It's an eye opener. Now, that said, let's do one last poll. And that's basically, what is your big takeaway today? We've talked about a lot of different things. Some of you know most of it. Some of you have never heard what I'm talking about before. So it's going to range. So we're going to end our poll. Roughly a third of you thought that checking your credit regularly was the big takeaway. Excellent. Excellent. If you do that, you will not be sorry. Keeping those line of credits open too, very important. You can really shoot yourself in the foot credit-wise, and I don't want you to do that, especially when you work so hard to get everything to where it's at, and to have those points disappear is just, it hurts your feelings. Knowing that 30 days past due is so important, yeah, that's a benchmark. And so 3 of you must want a credit score analysis, because now that you know we offer it, it's a game changer. So what I want to do is let you have my information. That way you can reach out to me directly if you would like. We can schedule them face-to-face. If you want to come into my branch, I sit at the 8210 West Market Street location, or my preference really is to do it virtually, because no matter where I'm at, I'm able to do those. And I share documents. I share a worksheet. I share your credit report and an action plan. So this is not a fluff discussion. This is a private discussion, and it gets to the root of how we can help you achieve your credit goals. I hope you learned something today that you'll take away and be excited about implementing. And I'm a resource for you. So please do not hesitate to reach out if you would like. There's an info sheet. You can request that as well. You can request it in the chat, or you can email me, and I'll be happy to forward it to you. Any questions now that we're at the end?
Yes, the CSA, is it a soft pull, or does it have any effect on?
Yes, it is a soft pull. Excellent
Okay.
question. We would not do a hard pull unless you were requesting a loan. Yes, and everyone who teaches them has had one themselves. So it was a game changer for me. And I really, it's one of my most favorite things to do for our members and even our business partner employees, because it's just so powerful.
The hard increase,
Yes.
does it hurt you or help you either way if you don't have any? Like, I have 3 right now and they're all about to drop off. Is it looked at negatively that I've not been applying for anything, or how does that work?
You know, if you've got 3 inquiries, that's not bad. What I would say is you just want to keep an average, you know, of 2 or less, just because we don't want to be, we once we get the credit we need, we want to take care of it. Now, granted, once we do an auto loan and pay it off, it's done. And the next time we need one, then we need one. So it makes sense to apply for that. But we don't want to apply for several credit cards at the same time or within a short period of time. That is a huge red flag, not just to the lender, but the bureau. And credit cards, they're not going to give you that lump them together rule like they do for car loans and mortgages. They want you to get a line of credit or a credit card and keep it and use it and maintain that credit. And there's no problem with you having several of those. Just don't apply for them all at the same time. Maybe once a year or as you need them, but just take care of them and don't close them prematurely. If you have to close one that has a ridiculous fee, be sure you're replacing it with one that's got at least that much of a limit or greater. That way you won't feel it in your score.
Thank you.
Sure.
Lindy, I had a question. This is Kay. You mentioned this, retail stores that sometimes offer you a discount if you open a credit card with them, like an on-the-spot discount. I think your message was that's typically not really worth it. If it's a really large purchase, maybe a certain percent off, might be enticing. But if you're not going to be buying a car or a house or any other large purchases, then could you do that to take advantage of the discount and then wait for your credit score to come back up in the future when you might need to buy a car or something?
That's a great question, Kay, and gives me the opportunity to elaborate. There's nothing wrong with doing that. If you shop there on the regular, especially if it's a big purchase and makes a nice little dent in that total purchase. I go to the mall almost never. I don't need any of their cards. I don't shop there online either. I'm kind of just that's how I do things. If you go to that place regularly, that might be the right card for you then, right?
Yeah.
Same is true with gas cards. There's no point in having 3 different gas cards. Get one at the one place that you use it, or 2 maybe, right? So you get the additional discount at the pump. But do what makes sense for you. Don't just do it for a discount on a one-off.
Yeah.
Right? Because the one-off purchase is costing you 15 points.
Yeah.
And 10% on a $50 purchase, I don't think that's worth it to me. If it's on a $500 purchase, maybe, especially if I'm going to shop there again.
Yeah. Yeah, that makes sense.
Yeah. So yeah, be strategic. I did not mean to make a blanket statement. Don't, not to do that. Just an example of where you're asked to do new credit, and maybe that's really not the best thing for you. Just be strategic about every credit decision.
Yeah. Someone else asked about Credit Karma. If that was a good credit reporting website.
Credit Karma is someone I use them, and I will tell you the one time that I had a fluctuation, it dropped 12 points, and I'm like, what's happening? And so I hit the next button that said, look to see what's happening. And I realized that my Home Depot card had a balance. And I thought, oh my God, somebody's got my card. Well, my husband, he had used it and forgot to tell me. He got stuff for the yard and he put it in the shed. And I never knew he made a purchase. And so as I'm about to cancel that bad boy, I thought, let me check. And so I texted him and he said, oh yeah, baby, I did that. And I'm sorry, I forgot to let you know. And I'm like, you got my blood pressure up for that. So it does give us alerts that are appropriate, because that could have been fraud, but it definitely let me in on what was happening with my credit, and I didn't know otherwise. So I'm grateful for that. What I don't want you to do is live and die by that score. I take a picture of it. Like I just do like a little screenshot on my camera phone, and just if it's fluctuating up and down more than a few points, and I mean 1 or 2 points, that's not normal. Unless I paid something off or just made a purchase that affected that, because that was my inquiry. I am expecting it. You're going to have ups and downs. It's just Credit Karma is good for letting you know where you stand generally. Oftentimes that score is on the high side. Now, I've heard other people say it's on the low side, but that's not been my experience, especially when you're going to do a mortgage. Mortgages pull from all 3 agencies, And you want those to be as close as possible because they're going to use that middle score. And extra tip, if more than one of you is applying, let's say it's a husband and wife or a couple, you want to be able to be sure that your partner also has decent credit because they're going to use the middle score of whoever's is lower. And that has prevented people from actually applying together before, if they can afford it. It's been a thing because there's marriages and couples that one has really good and one has really bad. It's pretty disappointing for that person with an 800 credit score to have their mortgage scored on a 650.
Yeah.
That's why a credit score analysis is really good, because we talk about your goals, we talk about what you want to accomplish and how long it's going to take you to actually do that at the rate you're looking for or at the time frame that you're looking for. It could be both. Don't let that opportunity pass you. You can do it, this month, next year, but do it at some point before you make a big purchase so that you can really be on top of what's what. And we only pull Equifax for the credit score analysis. We report to all 3 agencies for any of our loans. Not every lender is that way, but that's how we roll. Anything else?
When it comes to your credit scores and your FICO, what's the major difference?
Well, FICO scores, there's different ratings for them. That's an excellent question. That's part of why Credit Karma is different from maybe when you pull or have it pulled here at Summit. We're factoring in a lot of things. They're not factoring in nearly as many.
Mm.
So they're scoring it based on, and I don't know the exact number, but I'm going to say maybe 5 things versus ours might be 8 things.
Okay.
Okay. So it's just a little more in depth. And because of that, it's going to vary. It's interesting too. Your credit score varies from bureau to bureau to a degree, not because the algorithms are all that different, but because not everyone reports the same. We report to all 3. But a car dealership, let's just pick on Ford Motor Credit. Ford Motor Credit, I think they really do all 3, but let's say they only do 2 of them. They might only do Equifax and Experian. Well, then if your report is pulled at a car dealership for TransUnion down the street, they don't even know anything about the Ford you have. And so that credit information is missing, therefore it's not calculating into the score. That's another reason you may want to ask whoever you're lending or choosing to lend or borrow from, is not the right word, choosing to borrow from. Do you report to all the agencies? How often do you report? You can ask what day. They're not going to probably tell you if it's only once a month, but you definitely want them to report frequently and to all 3 in a mortgage scenario. If you've got that in the next couple of years, you want them to do that. That way you get credit for your credit.